How is everyone doing today? I hope everyone is having a wonderful day. I hope everyone had a wonderful trading day. First and foremost, I appreciate Kev for giving me this opportunity, providing this opportunity for me to teach about options. I love swing trading. I love teaching about options. Pretty much, we all know that with this game or with trading, we all can win. That's the beauty about the market. The market teaches and it preaches about abundance. So that's what I love about it. The fact that the person next to me, all they got to do is read a chart, learn how to read a chart, and they can make money for themselves, for their family, or for whatever they want to do. So that's the beauty about this. So I want to thank you again for providing me this opportunity. All right. So welcome, everyone. Welcome to the Swing Trading TheStrat Masterclass, hosted by myself, 8X. I appreciate you all for being here and taking the time out of your day. I'm looking forward to teaching you a thing about swing trading. You can find me on all social media platforms at 8X Trades for daily education, watch lists, and charts. All right, let's go. So first, a disclaimer. First and foremost, I am not a financial advisor. My content is for educational and entertainment purposes only and should not be taken as investment advice. Any form of investing carries a high risk to your capital. Any kind of educational tools, signals, or trading advice are not suitable for all investors. So please make sure you understand the risk involved. Past performance and any example of testimonial cited are no indication or guarantee of anticipated future results. Individual results will vary and cannot be guaranteed. Just got to give that. All right, so let's get on to the presentation. All right, so here's a list of topics that we will be covering today. First, a little bit of background on myself. Then we'll begin the presentation with what is the strat. Next, we'll talk about price action as fractal, followed by multi-time frame analysis and full time frame continuity, sector and sympathy rotation, swing trading with options, a swing trader's journey, and then if we have some time at the end, we'll go over some questions that you guys have. All right. So first, a little bit about myself. I go by 8X and I'm the owner of the 8X Trade Discord server. I've been trading options for about 3 years, or actually it's going to be more than 3 years now. I started trading stocks right before the pandemic and got into options a little afterwards. Once I learned about options, I thought it was pretty much game over and that this was going to be one of the ways towards financial independence. I am no way a professional trader or a financial advisor. I'm really just a dude who loves trading and teaching the people around me about options. Most will say that I'm just a nerd, all right? So I'm primarily a swing trader. Majority, if not all of my trades are based on technical analysis. I used to trade Elliott wave theory when I first started trading options, but I transitioned over to the strat back in fall 2020. I'm a student of technical analysis, so if a chart is not involved, I won't trade it. I also got dibble-dabbled in market structure. I know a lot of folks are into ICT and market structure as well. If using those theories also help with the strat. My main system is price action and sector rotation. If I'm trading a stock, I'm most likely looking at the sector itself as well. All right. So enough about me. Let's get on to the lesson. So part one, what is the strat? And this is going to just be a little bit review. Kev already told me that this is a strat group. Phenomenal. I love it. And so you guys already know some of these concepts. So I'm just going to go a little bit of review of these concepts, and then we're going to be talking about more in depth on the other advanced topics. All right. So what is a strat? So the strat is a price action trading strategy that was developed by a man, Rob Smith. First and foremost, I want to say rest in peace to him. Rob passed away last month due to health complications, and I know some of you have heard of him. Follow him on Twitter or listen to his videos. My condolences are with his friends, his family, and to the rest of the Strat family. And to be honest, if it wasn't for him providing this gift to the trading community, a lot of us either wouldn't be as successful as we are today or be able to understand price action the way it is today. So I just want to give my condolences before we continue. And so after more than 20 years of looking at charts, working as a trader at the Chicago Stock Exchange, Rob noticed that there were certain specificities or patterns when it comes to the way that price moves. He described price, and he said that price can only move in 3 ways, which he described in 3 scenarios. You guys probably know this. You have scenario 1, your inside candle. Scenario 2, your directional candle. Scenario 3, your outside candle. Now, the reason why stratters love this method so much, or love the strat so much, is because the strat eliminates market noise and focuses on what we can only see, which is price action. All right. So when we say that the strat eliminates market noise and only focuses on price action, this excludes all subjectivity. And I want you guys to write this down, that trading the strat is objective. not subjective. According to Rob, it is based on what we see and what we know to be true. So what we see at that current moment is exactly what we know. We don't guess, we just act, all right? The strat works by analyzing charts on multiple time frames. We'll go into detail about that. And it describes the three universal truths to price action. The three universal truths refer to time frame continuity, the existence of broadening formations, and the power or significance of inside bars. But I'm pretty sure you guys have already gone over these topics, so I won't spend too much time over them, but we'll go over a few of them later. And I do also have a YouTube video entitled The Beginner's Guide to the Strat that goes more in detail about the universal truths. And I also know that Kev already talked to you about this. So like I said, we'll go on to the next slide. So you have the three strat scenarios. When we talk about price movement or price action, we describe it in three scenarios. We have scenario 1, which represents the inside bar or consolidation, scenario 2, which represents the direction or the directional candle, and scenario 3, which represents the outside bar or where price is able to take out both sides of the previous range. Let's go on to the first scenario. So scenario 1 is when we have a bar that is not strong enough to take out the previous high or low. Now, everyone, I know we're stratters, so we all are looking in relation to the previous candle, and we're all looking at candlesticks. This inside bar represents consolidation. So as stratters, we're looking for the break of the inside bar because that usually signifies the strength of either buyers or sellers. So we know you mark your high, you mark your low of your inside candle, whichever side breaks, that's the side you take. Since we're trading option calls or puts, we would take puts in this case. So this is a scenario 1. This current candlestick doesn't break either side of the previous candle. Scenario 2. Scenario 2 represents direction. For scenario 2, price takes out one side of the previous range, not both, which is why it's called a scenario 2. This candle right here, you can see that if in relation to the previous candle, the candle only breaks the high of the preceding candle, therefore making this a 2-up candle, all right? If a candle were to break the low of the previous range, that would be considered a 2-down candle, all right? And as traders, we want to trade in the direction of most 2s. This is more examples. This is a 2-up candle where you take the preceding bar and you mark the high and the low. This candle only breaks the upside, 2-up. This is a 2-down candle where you take the low and this candle only breaks the downside of this candle, which is why it is considered a 2-down candle. Now on to scenario 3, okay? A scenario 3 is when candle breaks both sides of the previous range. And this is one of the most important elements of the strat and one of the most important things that every trader should know. Once you know a 3 exists, it will save your portfolio. And I'm going to say this again. Once you know a 3 exists, it will save your portfolio because you will no longer ask questions to why trades go against you if we create a scenario 3. I always tell people that when we create a scenario 3, it isn't a matter of, oh, I think it's going to go up. Oh, I think it's going to go down. No, when you see a scenario 3, it tells you exactly what it did, right? And that represents a possible reversal. So let me clarify, right? How do we create a scenario 3? In the first chart right here, you can see that price takes out both sides of the range of the preceding bar, this bar right here. How does the 3 get created? You cannot have a 3 bar without first starting out as a 2. So in order for this 3 bar to get created, price went up first, and you can actually see we opened at a high. So we actually opened as a 2-up candle. Then the price continued to go down. Oh, I should clarify about my charts. I apologize. My color scheme of my charts, yellow refers to green. So yellow would be up candles, and white refers to red. I apologize. That's just my color scheme for myself. So I hope that makes sense. And if it doesn't, we can definitely, when we look at trading view examples, we can look at different colors. But white is red and yellow is green. So in this case, this would be a 3-down candle because we started as a 2-up, and then price proceeded to take out both sides of the range, indicating that sellers are enforced, right? Same thing with this scenario right here. Now, why is a 3 bar important? A 3 bar is the reason why a 3 bar is important is because a 3 bar is one of the factors or tells us a lot about magnitude. Okay, so magnitude refers to how price can move. Like you'll often hear strategists like say like, oh, look at the magnitude of that play. Man, that magnitude is fire. What we're referring to is that we're looking at the setup and we can predict how far the play can go. And it's dependent on multiple factors. It's dependent on sector strength. It's dependent on fundamental catalysts, a trigger machine gun, which we'll talk about, the ATR of the stock, and the place within the broadening formation. Remember that scenario threes are a broadening formation on a lower time frame. All right, make sure you write that down. We'll talk about that later. So in conclusion, what do we know about the strat, or what is the truth about the strat? We know a couple of things, right? We know there are three universal truths when it comes to the strat, and we know, which refers to time frame continuity, the existence of broadening formations, the power of inside bars. We also know that price moves three ways, which we describe in three scenarios. Scenario one, inside bar. Scenario two, directional bar. Scenario three, outside bar. We know that price action is uniform, so you could trade it for any asset, right? There is no subjective analysis when it comes to the strat, which is why there is a language, because the strat takes an objective approach. When price breaks the high of the preceding candle, we know what price did. We don't ask question, did it do it? Yes, it did what it did. We know because it's quantifiable. And we also know that price doesn't move, it aggregates. Now, I haven't talked about yet. I haven't talked about that yet. What do I mean by price doesn't move, it aggregates? Well, that's going to lead me to part two, which is price action is fractal. All right. So are we okay so far? Going on to the second part. Part one was just a little bit review. Let me check the comments, check the chat, make sure you guys are good. Beautiful, beautiful, beautiful. Okay. All right. I like it. All right, good. All right, so part two, price action is fractal. So what are fractals? Fractals are infinitely complex patterns that repeat across different scales. They are extremely familiar and they exist everywhere in nature. If you guys have seen like a snowflake, right? If you guys looked at a snowflake, right, and put it right in front of your eyes, you'll see that there's different shapes within the snowflake that constitute or make up the bigger shape of that snowflake. That's what we consider a fractal. Technical analysis is derived from the analysis of human mass psychology, right? And so since human behavior is repetitive, fractals exist in markets. Financial markets are naturally fractal in shape and structure, meaning that the same patterns appear over time. Larger patterns and trends are built from the aggregation of compounded smaller patterns and trends. And these patterns play out sequentially over time. But time is always relative when dealing with future outcomes. The strat demonstrates the fractal nature of price action. All right, so what did he just say? All right, let's go into more detail, right? So since we trade the strat, you're all familiar with the 2-1-2 strat combo, right? 2-1-2. Since price action is fractal, a 2-1-2 on the hourly is equivalent or essentially the same as a 2-1-2 on the monthly time frame. The only difference is the time that it takes to get to target. I'm going to say that again. The only difference is the time that it takes to get to target. Now, I know you guys have seen this in the trading view chart. This took 1 hour to get to the top of the two, which was its target. This took a month for this two candle to get to the top of the two, right? Let me show you an example. So here we have two charts. In the first, you see that we have remember, green candle is referring to yellow and red is referring to white. So in the first, you see that we have a green to up candle right here, followed by an inside bar, then a two down candle. Same with the second chart. You see that we have a two up candle right here, followed by an inside bar, followed by a two down candle. So we can see that price essentially did the same thing. It went up, consolidated, then went down. Now, let's look at this example. Look at these examples. Those same charts that I showed you examples of, that was Apple on the daily, right? The first chart was Apple on the daily time frame, and the second one was AMD on the monthly time frame. You can see that price essentially did the same thing for both charts. The only difference was the time that it took to get to target. It took Apple 1 day to get to target, while it took AMD almost the entire month to get to target. What was the difference? Time, okay? So the time that it takes to get to target is the only difference about the nature of, or the fractal nature of price action, or these strat actionable signals. We all know about these strat actionable signals. So for those of you that like to trade, the 322 rev is my favorite, right? Let's say you're trading a 322 rev on the 15-minute, the 30-minute, the hourly. A 322 rev is the same thing on a 2-week time frame, a 3-week time frame, a 2-month time frame. The only difference is the time it takes to get to target. All right. What we see on one time frame is essentially the same as what we see on another time frame, right? That's what we mean by it being fractal in nature. Understanding that the patterns of the lower time frame create or influence the patterns of the higher time frame, that's going to help you a lot. So when you're looking at a daily chart, right, you should also be paying attention to the weekly, also be paying attention to the monthly, also be paying attention to the quarterly. And that's why as stratters, we have that 4-panel layout. When you see us looking at charts, when we look at 4 charts at the same time, is because we want to look at multiple time frames. We'll go into that in more detail, right? So traders should not focus on one time frame. Let me give you an example, let me just give you a hypothetical situation. When you're looking at a daily chart, right, and you see that the daily chart is pushing up, price is going up, what does that make the weekly candle look like? You'll see the weekly candle of that same chart pushing up as well. Then once you understand that, it's going to tell you, okay, then what is the next price action or the time frame that it could potentially trigger? All right. And this leads to my next point, which is multi-time frame analysis and time frame continuity. Okay. We all still good? Part 2. Is that good? Want to see some fires? All right. Beautiful, beautiful, beautiful. Glad I have y'all still here with me. Beautiful. All right. So part 3, multi-time frame analysis and time frame continuity. So what is multi-time frame analysis? Multi-time frame analysis is an essential tool to the strat. It helps traders identify the strongest assets to trade or with the most magnitude. And it involves looking at the price and candlestick formation on multiple consecutive time frames to confirm the strength of a trend. So we usually talk about, multi-time frame analysis, we got to look at price. We also got to look at the candlestick formation, all right? When price is pushing up, is it causing that candle to become a hammer, right? If it's causing the candle to become a hammer, what can that make the next candle possibly become? Because I know we're looking for that 2-2 continuation off that hammer, right? By using multiple time frames, traders can ensure that they are on the right side of the market, and it increases objectivity for their trading strategy. So let me give you an example. This is an example of QQQ, right? You can see QQQ, we had a green day, like we gapped down, but it's like, we have a green day. Maybe we might reverse here. Also, we're at a demand zone, previous demand. We wicked off this level. Hey, y'all, QQQ, and this is just me giving an example. I'm looking to enter calls based off this demand zone. I like this daily chart, right? Now, I wouldn't say you're wrong by saying that you would want to buy calls at this level just based off this demand. But what if you look at the higher time frames? Now, this is QQQ on the higher time frames. You can make a case for why we should short tech, right? Seeing that the week triggered a 3-2 down on the week, which we know is bearish. We have a shooter on the quarterly, which we know is bearish. And we have an inside month. Inside month represents consolidation. But if we were to let's just say we were to pick, which side are you more likely to break? The top side, the previous high of the month, or the previous low of the month? QQQ at this point, what we're playing what we know to be true is more likely to break the previous downside of the month. So if you were to just look at a day, you would have thought, let me go long. But if you would have looked at the entire or multi-time frame analysis, it gives you a better framework, or it gives you a better picture on what the trade can actually do. All right. So you can see that we triggered 2 down on the month. We're about to trigger 2 down on the month. And we triggered 2 down on the week, but we also or full time frame continuity to the downside besides the day and the year. So the week was down, the month was down, and when I say down, I mean red, and the quarter was down, red. When we talk about time frame continuity, why is that important? Well, the reason why it's important is because time frame continuity refers to achieving the highest probability trades when one side is particularly present during that trade at that moment. It is our goal as traders to identify who is actively in control in the given market, whether that be buyers or sellers in that given time frame. Time frame continuity, or full time frame continuity, I should clarify, full time frame continuity occurs when all time frames are pointing in the same direction and shows if the different participation groups are agreeing with each other. What do we mean by different participation groups? We're talking about the time frames. So you'll see us talk about daily participants. When we say, oh, are you a daily participant? You mean you're looking at the daily time frame. Are we green on the day or red on the day? If you're looking at a weekly participant, are we green on the day or red on the week? If you're looking as a monthly participant, are you green on the month or are you red on the month? That is what we're talking about with time frame continuity. When what you expect to see with time frame continuity, or what you should expect, what you should expect to see, or ideally, is that we want to identify and trade stocks that are moving in the same direction in all time frames. In other words, the best opportunities tend to lie in stocks that are trading in the same direction on the daily, the weekly, the monthly, and the quarterly candlesticks. If a stock is trading and aligning to these principles, we consider this stock to be in full time frame continuity to the upside or to the downside. And these are the type of trades that you want to look for, okay? Now, what happens when you combine multi-time frame analysis and full time frame continuity together? Well, that leads to the next concept of what I like to call the trigger machine gun, okay? The trigger machine gun is a price action phenomenon that occurs when you take the combination of multi-time frame analysis, time frame continuity, and actionable signals in succession. In succession, it means we're following one after the other, and I'll show you that. Multi-time trigger machine guns can lead to an exaggerated move, or what we like to call of magnitude. Let me show you an example of a trade that we took last year. So here's an example of a snap trade that we took. You can see that we were inside. Let me go to the weekly first. You can see that snap inside week, right? Shooter on the week and inside week. You can see that if we were to look at the 4-hour, kind of hammer on the 4-hour, but also we triggered a 2-2 down on the 4-hour, still full time frame continuity. The daily triggered a 3-2 down on the day. Oh, and I apologize. The reason why you don't see the 2 is because in my trading view, I only have the 3s and the 1s up, just because we know that everything else would be a 2. So that's why I just have the 3s and the 1s up. So this is a 2 down candle, right? So on the daily, we have a 3-2 down. We have a 1-3 on the 2-day, inside week, and a 2-2 down on the 4-hour. Now, before I show you the results of the trade, we understand what happens when, if you go inside week and you trigger 2 down on the week, what does that look like? You guys have probably played a 1-3 setup or a Nirvana pattern. You guys probably know what a 1-3-2 looks like. And you also know what a 3-2-2 continuation looks like. So what was the result of the trade? This was the result, a move of magnitude. TMG, or what we call a trigger machine gun. And I'll go over more examples of this. Pretty much, what are you looking for? You are looking for actionable signals on multiple time frames that are in succession. And what do we mean by in succession? It means that they are lined up right next to each other, right? Notice how, if I go back to the previous chart, you can see that we had the daily put trigger and the 2-day put trigger at $26.94. When the daily went down, or if you triggered 2 down on the day, you would also be triggering a 1-3-2 down on the 2-day. If you triggered a 1-3-2 down on the 2-day, that can therefore trigger a 2-2 down on the week, right? And I don't even have the chart up. I should, instead of the 4-hour, I meant to have the monthly, but this play also triggered a 2-2 down on the month. So what you're trying to do is line up as many actionable signals. And if they're lined up together, relatively close to each other in price, you can see an exaggerated move of magnitude. Now, one of my admins in my server, he described the TMG as, think of it as different time frames serving as market participants of their own. As one reaches their price target, they hand the baton to the next market participant with a bit of acceleration. If the triggers are so close to each other, it could potentially get through with a move of magnitude once it triggers in force. All right. So does that make sense so far? How we doing? You all good? Perfect. Got some fires in the chat. All right. And like I said, I'm going to be going over trading view examples. I hope you guys are sticking with me and you ain't done yet. We learning today. All right. Make sure you got the pens and papers out because we learning today. All right. Let's go to the next one. Part 4, sector and sympathy rotation. What is sector rotation and how do we use it to trade? I'm pretty sure you guys are pretty much aware of this topic, but let's just go over it. All right. So in the literal sense, sector rotation is an active investment approach where funds are transferred from one stock market sector to another, right? It enables the investors to benefit from an unpredictable financial environment and receive higher gains. Sympathy rotation, and this is something that I wouldn't say I coined, but it's just an idea that I like to think of, and I'll go into detail about it. It refers to the direct and non-direct relationships or correlations that exist between the market pairs and equities and how they change to market dynamics, economic cycles, etc. I'll go over that in detail. Don't worry. All right. So in sector rotation, you guys already know about the 11 spider sectors. There's more spider sectors, but these are the main or the 11 that we like to focus on. We like to focus on materials, XLB materials, communications, energy, financials, industrials, consumer staples, real estate, utilities, healthcare, and consumer discretionary. The reason why sector rotation is important, because once you understand where investors are rotating their money into, you can literally pinpoint the stocks that you need to trade. If investors are saying, hey, time to rotate into consumer staples, you also will be rotating into consumer staples. If we are going into the latter half of the year and now it is getting cold in some places of the world and now people are getting more sick and now you see that investors are now rotating into healthcare, you will also be rotating into healthcare. All right. Hopefully that makes sense. The investors move their funds from cyclical to non-cyclical stocks during an economic slowdown and reverse the movement during an upturn. Cyclical stocks refer or represent the companies that have a direct relationship to the company, while non-cyclical stocks repeatedly outperform the market when the economic growth slows. So cyclicals tend to go up and down with the economy, while non-cyclicals stocks they're usually steady earners, despite the fluctuation in the economy. So let me ask you guys a question, and I want to see you guys in the chat. Which sector, and I purposely put one that's not in the sector, but which sector are majority of these companies in? Spider sector. Okay, someone said tech. All right. Someone said we got an XLY. All right. We got a consumer staples, consumer discretionary. I like it. Consumer discretionary. Okay. XLY, industrial. I like the differences. Beautiful. Okay, discretionary. I like it. Okay, so beautiful. So I like how you guys said XLY and consumer discretionary. So correct. It is XLY or also consumer discretionary. Tesla's an XLY, Starbucks is an XLY, Airbnb is an XLY, and Amazon is an XLY. United Airlines is actually in industrials, but there's other, if you were to look at other consumer discretionary sectors, like for example, IYC, which is not a spider sector, UAL would be in consumer discretionaries, all right? So these companies represent, or they make or sell discretionary items and services that are in demand when the economy is doing well. So we know when the economy is doing well, everybody going to Starbucks. And when the economy is doing well, everybody shopping at Amazon. We got money now. Tesla, Tesla just came down in price, down to buy a Tesla, right? So when the economy is doing well, now, Airbnbs start going up because we all want to travel. So that is why we start rotating in consumer discretionary. They include restaurants, hotel chains, airlines, furniture, high-end clothing retailers, so much more, right? Now, on to the next one. Non-cyclical stocks, right, outperform the market during an economic slowdown. These non-cyclical stocks are generally profitable regardless of the economic trends because they produce or distribute goods and services we always need, including things like food, power, water, gas. I mean, like when we're in a recession, are people still going to Walmart and Costco to buy their groceries? Yeah, right? Are people, when we're in a recession, do people still need to go buy toothpaste? Right? You see what I'm saying? So these companies are also called defensive stocks because they can defend investors against the effects of the economic downturn. And so they're great places to turn to. Now, on to sympathy rotation, right? This is sector rotation. Let's go to sympathy rotation. So sympathy rotation refers to the direct and non-direct relationships that exist between market equities on a macroeconomic level, right? You have positive relationships or correlated relationships. For the example, when the S&P 500 rises, we know most times that the NASDAQ may also rise with the S&P 500. You can see that when technology stocks rise, you can also see that semiconductor stocks may rise. Why? Let's give you an example. When Apple's stock price rises, it can lead to a stock, or it can lead to the stocks rising in like Intel or AMD, right? Which supply semiconductors or supplies for Apple's products. Does that make sense? So that's why you can see a sympathy relationship between semiconductors and tech. When oil prices rises, this can lead energy stocks to rising as well. Okay. You also have negative relationships. I know you guys we are familiar with the VIX and SPY inverse relationship that it has is when S&P 500 rises, you can see that the VIX or the volatility index may fall. When NASDAQ rises, you can see that bond prices may fall. You also have uncorrelated relationships as well. Like for an example is like gold diverging with NASDAQ, right? We would consider gold diverging with NASDAQ to be an uncorrelated relationship because NASDAQ focuses on technology stocks, right? While gold prices can be influenced by global like economic conditions or like geopolitical events, right? So not in relation to tech, which is why that would be an uncorrelated relationship, okay? And we'll go over multiple examples of this on to TradingView. Now on to the next topic, part 5, okay? Now, the one that we're all waiting for, this is the one that I want you guys all to make sure you guys are paying attention to, make sure you guys are writing on your notes, because I know this is we're going to start getting into the nitty gritty of things on how we could really be successful with trading options. All right. So swing trading with options. When it comes to swing trading, what is the checklist that's involved on a daily and weekly basis when it comes to finding setups? Okay. The steps to creating a watch list include, and this is in specific order for me. This is how I trade. I chart the indices, look for actionable signals. Chart the sectors, look for actionable signals. Chart the individual tickers in the sector, look for actionable signals, right? And the important factors that you have to take into account when you are creating your watch list, you got to take the top-down approach, right? So you're looking at the higher time frames first, and then you're going down to the lower time frames. You want to look at market structure. And this is just saying like, are we at a support? Are we at a resistance? Are we creating a higher low? Just those things like that. Where are we in relation to the broadening formation? Are we at the top of the broadening formation? So it seems like the downside is more likely, or we're at the bottom of the broadening formation. And relative strength. You want to take into account relative strength too. Now, I talked about look for actionable signals on pretty much every single reason, right? What are the actionable signals? I'm pretty sure you guys already know what that is. You got the inside bar. We have the hammer, the shooter, the Momo hammer. Actionable signals are the reasons why you enter a play. So I want people to take this into account. You guys have traded before, and let's say you guys have been day traders and you learn how to swing trade, and you guys have been day trading the strat. Everything you have done on a short-term horizon, oh, I took the hammer on the 2-2 rev on the 15-minute to take it to target. Oh, I saw the inside bar on the 5 to take it to target, right? All this stuff and all these intricacies that you've been doing with the strat on the lower time frame, you use the same methodologies for the higher time frame charts, okay? So not only do we have actionable signals, we have the strat combos. We have the strat combo guide that gives us clear entries and exits when price triggers a certain strat combo. So if we know we have a 3-1 and we're looking for the 2 in either direction, we know where that potential price target is. So when you see a 3-1 on the monthly time frame and it triggers the next following candle is a 2 up, you know where that potential price target is, okay? In terms of entries, the entry, we already know this is just a little bit of review. The entry is the break of the higher low of the candlestick. And we know that the exit is the wicks of the preceding candlestick. This is the entry because we broke the 2-1-2 right to the downside. This is our exit. Previous candlestick highs or lows is used as price targets. And when in terms of exits, you guys have probably heard like a lot of strategists say this and this, and they're right in terms of one strategy, but it's different with this other strategy. You've heard say strategists say we use tight stops. We use tight stops, right? For swing trading options, we use invalidation levels, okay? Not tight stops. We trade options and we want to swing trade. Tight stops do not work. And we will talk about that in detail. If the actionable signal fails, then you want to be out immediately. This is how we protect our accounts. And you want to make sure that you are starting with starter contracts. And I'll go into detail of what starter contracts are. Then you add to your position upon confirmation. We scale out and secure profits as the candle reaches our price targets. Man, you guys already knew that. Does it make sense so far? Are we all good? Before we go on, make sure we're good. Cool. All right. So with the strat combos, we know that this prevents the need for emotions and it results in actionable trades only. Now, stop losses. Let's talk about stop losses. So trading options require a different set of rules in regards to stop losses than if you were trading stocks. So for options, stop losses are based on the underlying stock price, not the contract price. Some of us, when Apple is trading at 145, you're going to take the 150 calls for 2 weeks and you're going to be looking at the contract price. Oh, it's going up and down. I don't care. We don't care about that. We care about the underlying stock price. So if you get the 150 calls for Apple, you are caring about what price is Apple, the underlying, the actual stock, what price is it trading at, okay? It gets more complicated, and the reason why we don't have tight stop loss is because things get complicated as Greeks are involved. We know that Greeks are not constant. Greeks are constantly fluctuating and they're changing. So because Greeks are constantly fluctuating and changing, that is why you cannot have a stop loss. How many of you guys have been in a trade where price literally stays where it just stays in the same price that it's at for like an hour, but your contract is losing value just because that hour surpasses, right? That's theta affecting your contract. And that's why we say you cannot have a tight stop loss because it's dependent, or the Greeks are a factor when it comes into it, right? Invalidation levels and not tight stops. And the first point of invalidation for a lot of my trades is the 50% retracement of the entry candle, okay? This is important when it comes to staying in trades longer. Remember, we are thinking on a longer term horizon, so we need more time to play out. What else helps us stay in the trades longer? Let me introduce you to the TTO, or the TTO phenomenon, also known as a triangle layout. The TTO phenomenon, a lot of people, if you heard me in Twitter Spaces, if you heard me in my group or in my YouTube, the TTO is personally my favorite thing in price action. I love catching TTOs, especially because one, it gives you confidence because one, you got the direction right, which we'll talk about, and you can get a better entry. So TTO is referred to, triangle layout is a Robism. Rob created it, and it's another word for a pullback or a retracement. I like to think of it, and you can write this down, I like to think of it as a retracement back into its original trend. A TTO is a retracement back into its original trend. It looks like a triangle on a chart, and it gives you possible areas to add. Another thing that I want you to write down is that I have a saying that I say, assume a TTO until proven otherwise. Assume a TTO until proven otherwise, and this is going to help you stay in trades longer, and we'll go into more details about that. So here's what a TTO looks like. Price comes up, retraces, then back into its original trend. This is an example where if you draw it, price comes up, retraces, back to its original trend, and this is where we call it a triangle. Let's give another example. Here's another example in Walmart. Price goes up, retraces, back to its original trend. All right, so this is what a TTO is. The beauty about the TTO, or the beauty about using the TTO in combination of the strat, is that the strat will often signal when a potential TTO is coming. In this example, we see that we have an inside bar on the 15-minute, which represents consolidation after going, you can see red candles to the downside. So sellers made a move to the downside. Now we have our consolidation candle, and we finally reverse up, which starts the TTO to the upside. It is also important to note that a TTO is a broadening formation on another time frame. You can see that here on this slide, okay? This is your broadening formation that was created, and this is your TTO. When price goes up, we know that it's going to hit a point, come down. We want it to hit a broadening formation, and we're waiting to see where it will hit that broadening formation to reverse back up. Now, some people will say, okay, all right, so I know a TTO exists. Okay, price is going up. Now it's coming down. I'm just going to stay in the play because I know TTO exists. Well, what if it reverses it on you? What if it reverses it on you? What's the difference between a TTO versus reversal, right? So I want you to think of it like this. A TTO is a pullback when in full time frame continuity, okay? A TTO is a pullback when in full time frame continuity. Let me show you why. Let's say you are full time frame continuity on the day, the week, the month, and the quarter, right? Green, 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 green to the upside. Price is going up. I don't have it. I'm not showing a chart, but let's just say price is going up, right? All of a sudden, you now have a red day, right? With a red day, it is now red day, green week, green month, green quarter. The only thing that changed was that red day. As a stratter, you expect to flip that red day back green, and that is your TTO back up. I'll show you in a chart. Don't worry. So assume a TTO until proven otherwise when in full time frame continuity. And a reversal, a true reversal, actually signifies a trend reversal. And this is all dependent on where your entry is. Where your entry is and what the chart is looking like in terms of magnitude. A reversal can signify exhaustion risk, right? Broadening formation exhaustion, or if you're at support or if you're at a resistance. I like to look at the 50% rule of the previous bar. The 50% rule is very vital because the 50% separates bullish territory from bearish territory. And we can go over that in detail as well, okay? So once you understand the difference between a TTO and a reversal, we enter a swing trader's journey. Now, this is an example of a trade that we took, a Costco trade that I recently just took. You need to understand that with swing trading, now I want everyone to analyze this diagram. So first, let's go from the beginning. We entered Costco on the 2nd of June, right? And we got July 21st, 550 calls for $3.10. Price went down, and let me see, our entry was right here at 518.50. So if you can see right here, we entered on this 2-up candle. Price went down to this low right here at the bottom. You can see this 1-3 down. We were down 11%, right? Actually, I'm sorry, we weren't even down 11%. We were down 50%. I didn't mark it, but we were down 50% at this 3-bar right here. After this 3-bar, you can see that price went to up. From this 2-up candle, that 50% that we were down, we were now down 11%, okay? We averaged down on costs later, where you can see average down on cost 550 at $2.05. Then you can see we were now up positive right here because we were now in the gap. Price kept continuing up 34%. You're able to trim. Then look what happens after we get into this gap. Price comes down, okay? We went from positive 34% to now down negative 23%, okay? Is the journey done? No, because we're talking about magnitude, and we're going to be talking about, and I'll actually be showing you this trade on why we took it as well in TradingView, okay? I also signal that I bought more cost. New average is $1.88. Notice how I've averaged down twice now. I want people to understand that in the swing trader's journey, one, you should not expect to get paid right away. Write that down. You should not expect to get paid right away. 2, you should not expect to get the best entry. Why is it that we should not expect to get the best entry? 2 reasons. 1, we trade the strat. So for those of you that trade the strat, you know we buy or our triggers at the highs and the lows of candles. How many times have you seen, because you guys know this, how many times have you seen you buy it at the trigger and price retraces almost immediately, right? So we know if prices retraces almost immediately and our contracts are now going down, we did not get the best price. So you should not expect to get best entry. 3rd, mark your invalidation level. Not every play will go in your favor, but if you do your analysis right, most will. And I can say that confidently. If you do your analysis right, most will. We trade the strat. We're objective traders. We have entries, we have exits. We can see price formulating before price gets there. The more times you do your homework, I promise you can ask. If you do your homework and you're do how you're supposed to do it, more times than not, you will get the direction right. You've probably heard me say it in Twitter. I always say this thing, like more times than not, we get the direction right as stratters. Oftentimes we are just early. How many times, actually, I want to see it in the chat. How many times have you gotten a trade just for you to get out because you saw a pullback on a daily, just for 2 days later, it goes crazy? How many times? Almost too many, right? Someone said my life story. Yeah, like all the time, right? It happens all the time. So it got to a point, I was trading back in I tell people about this story back in 2021, where I got in a cat trade 3 consecutive weeks in a row because cat just looked fire. And it looked fire on a higher time frame. I got in just for the first day, it pulled back. And I'm like, oh, it's going against me. Get out. Next day, runs. And I'm like, that's interesting. Next week, I do the same thing. I get in. Oh, it looks good on this higher time frame. 2 days later, pulls back. Oh, no, never mind. Day later, runs. There got to a point where I was like, you know what? I keep seeing this phenomenon or this thing with price action keep occurring. I'm just going to see it retrace and I'm just going to stay in and see what happens. Then that is when I was able to see how contracts moved. Now, one thing I'm going to tell everybody, if you've heard me, I always talk about empirical evidence and my experience. Everything that I'm teaching you guys comes from experience and comes from trades that I've taken. I always talk about learning lessons. I say that L's are needed in trading because you learn from them L's. L's should be considered learning lessons, right? It took me getting clapped on cat 3 consecutive trades in a row for me to be like, oh, let me just hold and see what happens. And then I noticed that, oh, there's a retracement. Hold up, I was down 30% and I had a month left and now price is retracing back and now I'm back positive? Huh. Okay, now let me see how that actually works. And that is why a lot of people, I take strat entries. So I take that high, I take the low, even though I know the premiums can be expensive. But I'm go into it understanding that there can be a retracement or a pullback, okay? So what I like to say is, now I want you to take everything into account. We understand that price is fractal. We understand that when we see a 2-1-2 up on a monthly, we expect it to go to its target, given the fact that we have full time frame continuity and multi-time frame analysis lining up, right? If that's the case, that leads me to my fourth, which is trust the chart and trust your analysis. There's too many times where a lot of us get into trades, we did our homework right, and we get stopped out just for the trade to do exactly what we expected it to do. That's why I say I say to anyone, you were right. Trust that you're right. Be confident that you did the homework, that you were right, right? And then it's just a matter of the emotion and psychology while being down, and then to hold on through to get to your price target. So in this example, I'm sorry that I rambled on, I often go into tangents, but this example, I took it based off and I'll show you in trading view. I took it based off the 1-3-2 up on the 2 week. I expected it to get to the gap fill target. It did. Even though it came down a couple of days, came down a fake 1-3-2 fake out like here, came down a little bit. Look at my invalidation. I talk about invalidation. This was my invalidation level at the 495.85. Unless Costco goes to 495.85, I ain't getting out. Oh, but you're down 30%. Cool. Oh, but you're down. Cool. Did it hit my level on the chart? No, I ain't getting out. Now, this is based off the premise of technical analysis. It's not that we're trading and we're guessing that, oh, I think it's going to get there. No, I will give you technical reasons why I believe Costco is going to that target based off the gap, based off full-time frame continuity, based off the actionable signals, based off everything, right? So it's not just we're guessing it. We have quantifiable empirical evidence that tells us that we believe that Costco is going to get to the gap, all right? So that's why I say trust the chart and trust your analysis. And that leads me to my conclusion. What would I say are the most important factors to swing trading options with the strat? First, you want to pay attention to multi-time frame analysis and time frame continuity. which will give you insight to the potential of magnitude of the play. By using these principles, we can ensure that we are on the right side of the trade, and it gives us confidence that price can actually hit our target. Third would be actionable signals and TheStrat combos. We know that price is fractal. A hammer on the daily time frame represents the same type of price action as a hammer on the monthly time frame. What does a hammer mean? They bought it up. Price was at a low, and then buyers bought it up. That's the same thing on the daily, is the same thing on the monthly. A 3-1-2 up on the 30-minute is the same as a 3-1-2 up on a 2-week time frame. The only difference is the time that it took to get to target. 4, invalidation levels. Swing trading requires invalidation levels and do not require the use of tight stops. We trade options, and we understand that Greeks are involved and Greeks are constantly changing. Therefore, we need to stay in the trade longer, all right? And last but not least, buy time. Time is the most important factor when swing trading. We know that time equals insurance. The reason why the premiums are more expensive when you're looking at longer dated contracts is because they're factoring insurance. They're factoring the time that, oh, because you're giving yourself a longer term horizon, there is more of a probability of this stock or this trade actually getting to the strike price just based on the probability that you have more time, right? Just given the fact that you have more time for anything, the probability exists for something to happen. You get what I'm saying? And that is why it is more expensive, okay? Now, that is the presentation. We're going to be going on to some trading view examples. How am I doing on time, Kevin? How are we doing? Is everything okay? I'm going to make sure. I don't think I could hear you. I think you're muted. Maybe can I mute you? Oh, you should be able to unmute yourself now. Let me see if that works. Oh, yes, sir. Yes, sir.
I'm over here taking notes, the chat going crazy. So yeah, man, I'm loving it, man.
Beautiful, beautiful, beautiful. I appreciate that. Thank you, thank you. Okay, if that's the case, let's go on to some trading view examples. Okay. Right. So make sure y'all can see real quick. Okay. Oh, good. Okay. So let's go on to some trading. All right, good. Okay, some trading view some examples. So let's first start with the scenario 3. All right. So I'm just gonna bring up scenario 3 right here. Okay. So you guys have already seen what scenario 3. I'm just gonna show you what a scenario 3 happens, because remember what I talked about is that a scenario 3, it can only be created by becoming a scenario 2 first, right? So let me just show you what that looks like. And let me actually bring this real quick. Bring the 2. Okay. So if I were to use the replay tool, you can see that Apple on the week, this is a 1-week time frame. What did we open as? We opened as a 2 down candle. Okay. You guys see my screen? We opened as a 2 down candle first, right? Then you can see as price went up, price went down first, creates a hammer, boom, went 3, right? So that's an example of a scenario 3. Price needs to come down first. And the thing about scenario 3s is that scenario 3s show aggression. Why do we talk about that it shows aggression? The reason why it shows aggression is because buyers, in this case, buyers were able to take price from a low, right? We were below the previous range, and they were able to bring price all the way back up to take out its high. That means, and it shows aggression. We, as straters, we like to look for 3s, 3-1-2s, 3-2 continuations. 3 show aggression because they show 8 buyers are in there. There's one example that I love to show people, and I want to give a shout out to Alex Options because he was the one who actually showed me this example in one of his videos. If you were to look at Tesla on the 12-month, this is why we like 3-2 continuations. Look at this. Going into 2020, Tesla gave you an outside hammer 3 for the year. For the year. We talk about price action being fractal. This is for on the yearly time frame, outside year, look what Tesla did from $28 all the way to $239. And this was before the stock split. So it was really on some like 100 to like 600, if you get what I'm saying. You know what I'm saying? So this is what we're talking about with scenario threes, that they show aggression, especially hammer threes or shooter threes. That not only indicates a pressure, right? If you got a hammer, that indicates buying pressure, but the three also indicates aggression. Buying pressure plus aggression, boom, right? Shooter, selling pressure plus aggression, boom. That is the importance of a scenario three. It shows aggression. On to the next slide. Price action is fractal. So what do we mean by this, right? Now, we talk about all the time, if we were to just go to SPY and we go to, actually, I don't need to go to SPY. Let's go to the daily. A lot of us are day traders, and a lot of us like looking at the 15, right? 15 or 30 minutes. So let's just go to an example. What did SPY do today? We see that we have a 212. I'm just taking one time random time frame. We have a 212 on the 15, right? 212 hammer on the 15. All you got to do is just go on SPY on like a 1 month. Okay, and you'll see, where is it? 212, same thing on these higher time frames. Okay, so when we talk about price action being fractal, like you guys already know the type of actionable signals you like to trade, right? Let's say you like to trade the 2-2 rev on the month. If you know that you like to trade the 2-2 rev on the month, then you can play the 2-2 revs. Oh, I'm sorry, not the 2-2 rev on the month, 2-2 rev actionable signal. Then you can play 2-2 revs on the month. My personal favorite.
Vivian Porter returning your phone call.
Oh, let me. I think I didn't. Let me just unmute it real quick.
So the next steps is just I write a repair estimate. I submit it to the insurance company, and then they contact you once their review is complete.
Okay,
They really don't give me any information, but I have to have my report submitted
let me
within
mute people.
48 hours. I'm an independent contractor, so I'm hired by AAA. They don't really have a lot of adjusters that are actually like AAA employees, so they subcontract the work. Yeah, so I do all their field inspections.
Mute. Okay, there we go. My bad, y'all. My bad, bro. sorry.
No, it's all good.
All right. So I hope y'all good. So we talked about price action being fractal, right? And we just gave the example of the 2-1-2. One of my favorite strat patterns to play is the 3-1-2, or what I like to call the 3-1-2 see you later. Okay. The 3-1-2 see you later, I'm going to show you examples. So you guys have probably seen a 3-1 before. Let me show you. Let's go to XOK on the month. XOK on the month. Okay, I'm going to show you this. Okay. This is why I've coined it the 3-1-2 see you later, because look what happens a lot of times after you go 3-1 or you create a 3-1 candle. It can be followed by a 3-1, 2 up, 2 up, 2 up, 2 up. You got to fail 2 down, or no, you got a 2 down, but it's hammered. But you continue the trend, 2 up, still continue the trend, 2 up, 2 up, 2 up. From this 3-1, price went from $123 for XLK all the way to $177. Let me give you another example. Let's look at Oxy on the month. Look at Oxy. Let's look for a 3-1. Actually, we can look right here. 3-1, look at this one. 3-1 on the month, right? Off of a shooter. Look what happens after this one was created. 3-1, 2 down, 2 down, 2 down. You had a 2 up, but it didn't break above your entry, or it didn't break above the candle that you used to enter, and it proceeded to go 2 down, 2 down. So from this 3-1, you made a move from this one from $42 all the way down to $8 for Oxy on the month. Look at this example right here. This is another 3-1.
Ask a question.
Yes, you can.
You see that 3-1 strategy. Did you get in was your entry at the bottom of the one, or once the 3-1 formed? The one formed?
Bottom of the one, right there. Yes.
Okay.
Bottom of the one. Yes, sir.
Can we just wait until we open it up for questions? I thought I had it set to where can you not unmute yourselves and just kind of wait, just out of respect for 8X?
I should be able to. Okay, we could. I think I was able to move everybody. I appreciate that. But yeah, of course, at the end, we will have as many questions as possible. Please write all them down. I love questions. Like, you have no idea. Those are my favorites. So look at this 3-1. Another example, you had a 3-1 right here. And after this 3-1, you proceed to go two down. You had an inside bar. And I want people to remember this. This is your entry, right? Entry. You took the trade based off the 3-1 on the month. So what would invalidate the 3-1 on the month? 3-1, 2 down on the month. What would invalidate this trade idea? If you were to go 3-1, 2 up on the month. So if you mark your invalidation right here, invalidation level, right? Does price ever reach your invalidation level? No, it does not. And you can just take this route, ride this the entire way down. Look at this. We can just go back. Here's another 3-1 on the month. This is your entry right here. Entry when price breaks 2 up. Then look what happens to Oxy. 3-1, 2 up, 2 up, 2 up, 2 up, 2 up. A move from $62 to $74. We can look at any time frame that you want to. If we go to MU on the week, let's just go MU on the week. Let's find the 3-1. Oh, there it is. Oh, I actually marked it already. Look, 3-1, 3-1, 2 up, 2 up, 2 up. Another 3-1, 2 down, 2 down, 2 down, 2 down, 2 down. Another 3-1, 2 up, 2 up. I think it keeps going. Yeah, another 3-1. Oh, this is an example. I'm glad I showed this one. This is an example of a 3-1, 2 down, 2 up, 2 up. Now, the reason why you'll hear me say that the 3-1, 2 see you later, you don't really want to take the move of the first 2 candle. It's really the second 2 candle that starts the 3-1, 2 see you later. So even though right here you have a 3-1 and you take this 2 up, this is the first 2 candle. Yes, you can take it, but really you should start seeing it either in the first or the second 2 up candle. In this example, 3-1, 2 down, you get the direction in the first, follow with continuation on the second 2 up candle. So what does that mean? You'll see, what I like to say is that you'll either see a 3-1, 2 down, 2 up, 2 up, 2 up, 2 up, 2 up, or you can see a 3-1, 2 up, 2 down, 2 down, 2 down, 2 down, 2 down, 2 down. The second candle oftentimes gives you the true direction of what the direction of the 2s will be. Does that make sense? I want to make sure I'm making sense when it comes to the 3-1, 2 see you later. Cool. All right. I like to call it 3-1, 2 see you later. There's a stock like Abivai. It's to the point where when you see a 3-1, I want people to like recognize this. It's to the point when you see a 3-1, you can often conclude what is about to happen, right? Abivai. I say, like, I love playing Abivai when it shows me a 3-1. People like to say, oh, why do you like to play that? Because every single time I play Abivai in a 3-1, it gives us over a 300% play. I will show you. Back in 2021, when it gave us a 3-1 on the when it gave us a 3-1 going to November, we got December contracts, we got January contracts. Look what Abivai did. 3-1, 2 up, 2 up, 2 up, 2 up, 2 up, 2 up, and kept going. You went from $119 to $138. The next fall, Abivai said, we're going to give you another 3-1. And I said, hey, y'all, last year, Abivai gave me a 3-1 on the week, went crazy. Abivai's giving you another 3-1 on the week. Watch what happens. 3-1, 2 up, 2 up, 2 up again. It did it again earlier this year, right? Back in March. 3-1, 2 up, 2 up, 2 up, 2 up, 2 up. So now let me tell y'all something. Let me ask you, if you know, because I tell people this, if let's say in some utopian world, we know that every single time you get a 3-1, you have a 70% chance to go 3-1, 2 up, 2 up, 2 up, 2 up, 2 up. If you know you have that percent or that profitability or that percentage, why not just look for 3-1 trades, right? If you know every single time you get a 3-1, why not just take 3-1s? Because you know that the following candle is going to lead to a move of magnitude. You get what I'm saying? That's just the 3-1, 2 see you later. Let me go back. Let me. If you guys really think you think the 3-1, 2 see you later is something, let me tell you about the 1-3-2. The 1-3-2 is dangerous. I'm talking about dangerous. The inside bar followed by the outside bar. Let me show you. AMD 5-day. Let us show you. Oh no, let me show the 10-day. AMD on a 10-day. All right. So the reason why, because people ask, oh, why was the reason why you got into trade? Because, and I tell people like the chart, you're going to start being able to say, oh, the chart said we were supposed to go long, right? Look at what AMD showed on the 10-day. AMD 1-3 on the 10-day, right? After 1-3, we know about those hammer threes. What did it lead to? 2 up, 2 up, 2 down, 2 up, 2 up. Your entry was right here, right? Your entry, this is your entry. Your invalidation. Remember, I talked about the 50% rule, 50% being my invalidation, my first point of invalidation. When price gets to 50%, you don't get out. You wait for a close below 50% on the time frame that you took the trade on before getting out. So I want people to realize this. AMD on the 10-day, we triggered 1-3-2 up on the 10-day. I took the trade based off the 10-day. So therefore, the 10-day has to be the reason why I get out of the trade. So unless I get a reversal on the 10-day candle, I'm not getting out of the trade. As long as you mark your invalidation on the 10-day candle, it will tell you if you need to get out of the trade. 50% rule, mark it real quick. Boom, boom, right here, 0.5 fib. Did AMD ever invalidate? AMD said, if you buy now, your stop loss is here. You have the potential to go for this entire run. You took it on the 10-day chart, remember? So remember how I said buy time? This is even another topic that we can go over. When we're talking about buying time, you are anticipating the future candlesticks. Anticipating the future candlesticks. So remember, I talk about you got to pay, like oftentimes I see traders like, in FinTwit, and I'm like, why did you go short here when it was a hammer on the day? And I'm like, people really just don't pay attention to what the candle is telling them. The candle literally tells you what's about to happen. You have a 1-3 on the 10-day, right? If you anticipate the future candlesticks, you are anticipating a 2 up on this candle and then the following 2 up on the next candle. What does that mean? That means you need to be in the trade for 10 days, 20 days. Is that making sense so far? Right? The time frame that you take the trade on lets you know how long you need to stay in the trade for, or at least a minimum. So if you see a 1-3-2 up on a 10-day and you're anticipating, damn, I think the next candle could be a 2 up too. If you think the next candle could be a 2 up too, then it means you need to stay in AMD for another 10 days because you're anticipating the second candle forming. You get what I'm saying? So look at this. AMD, and this is why I love swinging. That's why I say, bro, swinging is dangerous. And swinging, it's like insulting, bro, because this is why, like, you guys will hear me. I preach 100% plays and up. And what I mean by that, I mean that the market gives us the ability to find 100% plays and up. You just got to find it. You just got to look at the time frame. You just got to buy enough time. Right now, there's this velo play that we're currently in. We're at 600%. And we took it 2 months ago because time frame continuity tells us, or that there's abundance in this market. You have the ability to get 200, 300%, 400%, 500% plays as long as you buy time and you're looking at those higher time frame signals. All right. So AMD on the 10-day gave you a 1-3-2 up, 2 up, followed by 2 down, and it kept going all the way to here. Let's look at SPY. Let's look at SPY. Where did it do it? Well, okay, here we go. 1-3 on the 10-day for SPY. You had a 1-3, 2 up, 2 up. You had to stay in this play for 10 days, had to stay in this play for another 10 days. We can look at SPY on the 5-day chart, right? Notice how I'm telling you price action is fractal, y'all. Like these different time frames are telling us where price can go. SPY on the 5-day chart, you got a 1-3 followed by a 2 up, 2 up, 2 up, 2 up. You had need to stay in this play for 10, 20, 30, 40 days. And you know the beauty about the strat? The strat even gave you an actionable signal to tell you when you should get out or get out of your runners because it was followed by an inside 5-day. Then it went 2 down, 2 down, 2 down. Really meticulous, right? You can also see you even had a 3-1 see you later on the 5-day chart. 3-1, 2 up, 2 up. And the beauty about these 3-1 see you laters, I promise you, most of the time, when you have a 3-1, all you got to do is mark the bottom of the 3 to make that your invalidation. Price ain't going to come back. Price ain't going to come back. You mark the 3 as your invalidation when you see 3-1. Like most times than not, if you're trading with time frame continuity, price is not going to go back, right? So you need to look at these higher time frames because I want to show you another example. XLI on a 2-week chart? Why was I long UPS and everything on the 2-week? Because, or CAT, DE, oh, and we're going to talk about CAT. Shout out to Kev, because he been smacking DE and CAT. But like XLI, it gave us a 1-3 on the 2-week chart. This was back in May. And I told everybody, get ready to go long on industrials. Get ready to go. Why? Because the 2-week chart gave us a 1-3 on the 2-week. I'm anticipating a 2 up and another 2 up. If that's the case, I need to be in the play for 2 weeks, 4 weeks, at least 4 weeks. Now, I'm not even getting into the type of contracts you need to buy so you can buy that insurance, because what I like to say, the time frame that you take the trade on, you need to buy at least 2 to 3 times that time frame for insurance. So like if you're taking a trade based on the 2-week, multiply that by 2 and 3, you need to buy at least 4 to 6 weeks out. But that's another topic in another day. XLI on the 2-week chart, right? 1-3 on the 2-week. You're anticipating a 2 up, 2 up, 2 up. There's multiple examples. Let me give you you think I'm tripping. Hold up. Microsoft on a 12-week. Hold up. Bro, what if I told you Microsoft, this is why I love swinging. What if I told y'all Microsoft gave you a signal back at 280 telling you to go long and you could have taken $340 if you had looked at Microsoft on the 12-week? All you had to do was look at the 12-week. This was the entry back when? January? On the 12-week chart? On the 12-week, like look at it. Like that's the beauty about what I'm talking about. Price action is fractal. Yeah, I don't care what time frame. I tell you, just give me a time frame and give me an actionable signal. I'll tell you where price is going. You're going to be able to say where price is going depending on these time frames, right? What's another one? Amazon. The reason why I'm long, I've been telling people go long on Amazon since 2 months ago. Why? Because if you look at Amazon on the 7-week chart, hold on, give me 1 second. 7-week chart. Bro, Amazon gave you a 3-1-2 up on the 7-week. Like when that look. Now, I'm not telling you, look, that's the chart. The chart said 3-1-2 up on the 7-week. The chart said you can go long on Amazon. You have 7 weeks. You need to anticipate 7 weeks, 14 weeks, 21 weeks. Amazon said at the bottom of the Brownian formation, buy leaps. And it's not me. The chart is saying that. Oh, y'all don't even, the 7-week? Oh, I'll go crazy. I'm talking about, you see these time frames? I got the 30-minute, let's go 30-minute, 65, 130, 195, 1 hour, 2 hour, 4 hour day, 2 day, 3 day, 4 day, 5 day, 6 day, 8 day, 10 day, week, 2 week, 3 week, 4 week, 5 week, 6 week. I ain't playing around. I'm trying to see all the time frames. Why? Because I'm trying to catch when CCL wants to do a double inside 6-week breakout and it does this. Why would we long CCL? Because we got a double inside 6-week. You know what I'm saying? I can go into more details. We talked about the 3-1-2, see you later. Let me talk about sympathy rotation. So sympathy rotation, right? We talked about looking at stocks, looking at things that are within the same area. When you know you're going to be playing, for example, I know Kev's talking to you guys about CVX and XLE, right? Why is he talking to you about that? If you look at XLE on a higher time frame, look at what XLE doing on these time frames. 2-2 up on a 5-week, 2-2 up on the 3-week, 3 level. It's not even playing. Look at it. 3-1-2 on the 3-week chart. 3-1-2, see you later on the 3-week chart. Isn't that similar to what Amazon was showing us too on the 7-week? Yeah, because these patterns repeat themselves in multiple time frames. So when we talk about sympathy rotation, if we know XLE is going crazy, then what are we going to be playing? Then what are we going to be doing? We're going to be going in XLE and playing the corresponding stocks within XLE. Looking at CVX, looking at ZOM, looking at Oxy, looking at EOG, looking at VLO, looking at SLB. You want to know everything, right? If you know, even before XLE is going crazy, you're looking at CL. You're paying attention to crude. If crude is telling you we have the potential to go crazy, hold on, I don't even know if people pay attention to crude. Look what crude doing on the 6-month time frame. Tell me where crude is going. Have people paid attention to crude on the 6-month? You guys trade strat, right? So we know we triggered a 2-2 rev on the 6-month. Where's price? Where's our target? It tells you. I'm not telling you. It tells it. The chart tell you. I'm not the one telling. The chart tell you, and the chart also tell you that this price target of 111.64 will get invalidated if we break below this too. That's why I say you mark your invalidation levels. Strat tells me because we broke 2-2 rev on the 6-month, I expect price to be at 111.64, and then I will reverse course if we break below my invalidation, which is at $62.64. Simple as that. So if we know that crude did that, right? Then that is why, and we know we did it on a 6-month time frame. That's why I'm telling people, yo, energy low-key scary, because I wonder if it's setting up for a run into the end of the year. Because the 6 month tells us you can go 2 up on the 6 month. And remember, y'all, the reason why we buy time, even if, let's say we trigger 2 up on the 6 month in force, and let me just go an arrow right here. Give me an arrow. Come on. Okay, let's say we go 2 up, right, in force. If we don't, let's say we get to the December 31st and we like 50% of this previous 6 month candle, then we would be anticipating the next 6 month candle to go 2 up. And that's why I say you need to buy that time. If you're taking the trigger off of a 6 month trigger, you need to buy 2 times 3 months that time frame. So you would be buying leaps, you'd be buying a 12-month or 18-month contract. Why? Because just in case you don't get to target on this 2 up, the next 2 up can get to target and you'll still be in the play. Right? And that's why time is very, very important. When people ask how much time, people say, how much time are we buying a contract? I say, what time frame are you taking the trade on? The time frame that you're taking the trade on lets you know how much time you need to be in that position or how much time it's going to potentially play out. All right? So CL, we know if CL going crazy, we're looking at XLE. We're looking at the individuals tickers within XLE. We know if XLI is going crazy, and we know that DE is going crazy, right? What are we going to be playing in alignment with DE? A sympathy, CAT, right? Because CAT and DE are in the same sector. They move with each other. We know that if Tesla is going crazy, then we're going to be looking, is Amazon going crazy too with Tesla, right? Because they're in the same sector. Or let's say EVs are just pumping, right? If EVs are just pumping and you know Tesla's going crazy, then you want to make sure that you're looking at the Drive ETF that contains all of the other EVs, because you want to see if you're going to be playing the NIO, you want to see if you're going to be playing the GM, you want to see if you want to be playing the Fords, right? If you know that AMD is going to be going crazy, what else? And you don't want to be playing AMD because they have ER this week. What stocks are you going to be trading? You're going to be trading the TSMs, you're going to be trading the NVIDIAs, the MUs. Sympathy rotation, because they move with each other, right? If Home Depot has earnings tomorrow morning, if Home Depot goes crazy, you expect Lowe's to also gap up too, right? Like all of these sympathies that you need to actually pay attention to how these stocks move in relation to each other. You guys, if you guys follow me on Twitter, you guys hear me talking about Costco and CAT and all the time. The reason why I like Costco and CAT is because Costco and CAT have relatively high ATRs. When they want to move, they don't just move for one day. They will move. I mean, y'all seen CAT, right? Like we can just look at like y'all seen CAT. This is why I like CAT. I call CAT Catherine because CAT go crazy. Look at it. It goes 2 up, and people be getting out on one day. That's why I'm like, bro, if you had the opportunity to swing, you're telling me you don't want this entire move? You're telling me you don't want this entire move? 2 up on a 9-week? Did you see that? The 9-week chart tells you, hey, we can go from 250 all the way to 280 if you saw that inside candle on the 9-week chart. I'm telling you, y'all, swinging, like I tell people, I'm trying to be disrespectful to this market. Kev been swinging. He been disrespecting this market. The way I saw that DE play when DE kept going up, and he was like, "Bro, this shit keep going up. Why not? That's why I swing. I'm looking this is just sympathy rotation. I'll talk to you about TTO versus reversal real quick. Look in NVIDIA. I'm going to give you NVIDIA an example. Like if you guys, we was talking about NVIDIA. I told everybody, but NVIDIA going to 300. Everybody's like, oh, why? You don't think it's overextended? I'm like, bro, what is overextended? Do you not know what overextended means? With full time frame continuity, they ain't no such thing as overextended. You talking about SPY and SPY 2020 was overextended when it kept going up? Full time frame continuity said, nah, we going up. When I tell people that NVIDIA, there ain't nothing stopping NVIDIA till 300. People are like, why? Why do you believe it? I'm like, bro, just look at the higher time frame. Like, what do you mean? Look at the higher time frame. What do you mean? Did you look at the 3 month? Yeah, but I don't see anything. Did you look at the 6 month? Oh, snap. Pop. There you go. 6 month. It was the 6 month that told us NVIDIA can go crazy. Hold on. Let me show y'all real quick. Do this. Okay. NVIDIA, we know what a 2-2 rev looks like, right? This would be an entry for a 2-2 rev. Entry. Boom. Look what NVIDIA did. Let's go. Boom. 2-2 rev in the 6 month. Strat said our target $307. So I was telling people that NVIDIA, full-time frame continuity to the upside, when you guys saw it running this, like, bro, it's going to 300. Why? Look, the target says 300. The target says 300. And that is why people were able to get, I mean, I know the ER move alone, people were able to make a lot of money on that, but boom, if you swung it from January, like, that's your target. That's why the strat is so important. I mean, the strat, like, understanding the strat in higher time frames, the perspective in higher time frames, you can go crazy. Like, I'm telling y'all, bro, NVIDIA, what if somebody told you, hey, NVIDIA got a 3-1 on the 6 month and we're about to go 2 up on the 6 month. You trying to get some leaps real quick and see what it do? Bro, there it is. 3-1, 2 up, 2 up, 2 up, 2 up, 2 up, 2 up. From $40 all the way, bro, to $360. Does that make sense? So, like, this is why I say, look at the higher time frames. You got to take a top-down approach. Look at the yearly. Look at it from the yearly. Look at it from the 6 month. Look at it from the 3 month, the 2 month, the 4 month, the 1 month, the 9 month. Like, I look at all time frames to tell me where price can particularly get to. Because I expect TTOs until then. In this example, I talk about TTO versus reversal. NVIDIA, I say NVIDIA is just one big fat TTO all year. This is just a TTO. All this is, this candle right here, all NVIDIA did was TTO to get to that price target. You don't believe me? Watch. Look, right here. You can just draw a path. NVIDIA. Up, down, up, down, up, down, up, down, up, down, up, down. This is just one big TTO. Y'all see it? Just one big TTO. And this was your entry. Did we ever? That's why I say mark your entries and your validation. If you entered based off the 6 month time frame, did price even come to even retrace into it to tell you to get out? No. No. Okay. So this is why when it comes to TTO, like you got to mark whatever candle that you took the trade on, 6 month, right? You mark 50% of that previous candle. Now people will say, wait, hold up, but this is a 6 month time frame and this is NVIDIA. That means it came down all the way down to 150 and my entry was 192. Yes. You not getting out of the trade until NVIDIA closes below 150. You took it based off the 6 month. So you went into the trade expecting it to take 6 months. So why are you getting out during month 1 when we didn't even close yet? You get what I'm saying? That's how a lot of people get shaken out. Like, and I tell people the strat does not get best entries. I know Kevin got y'all talking about market structure and ICT. Now, once you guys incorporate strat and ICT, oh my gosh, don't even get it started. But the strat does not give you the best entries, which is why I say buy a starter at the entry. When it pulls back, then you buy more. Because we go into the trade, I go into the trade not expecting to get paid, and I go into the trade thinking that it's going to come down. And think about this. I have a saying where I said red means green. With swings, your trades are going to be red some days where where you can't do anything. The thing about like this switching from a day trading psychology to a swing trading psychology, day traders, we like to get paid every day. With swing trade, you ain't going to get paid every day. Some days are just managed days where it just accumulating in price. It's not doing anything. Like CVX, you guys have been in CVX, I'm assuming, right? CVX didn't really do anything much today. This is just one of those days where it just doesn't do anything, but then tomorrow it could do something. That's the thing with swinging. You may want, I'm looking forward to the market today, but market said, nah, we ain't gonna do anything, buddy. And there's nothing you can do about it. You get what I'm saying? So like, you just have to understand, as long as it don't hit your invalid, I always say target or invalidation. Target or invalidation. It's either going to hit your target and close below, or it's going to get to it's going to either hit your invalidation and close below your invalidation, you get out, or it's going to get to your target. Nothing in between. The whole fluctuating, we gapped down today. Cool. Nothing. That's cool. Wait. Nothing you can do about it. All right. So that's the TTO versus reversal for NVIDIA. Now I'm going to show you guys the power of consolidation. Let me give you guys a cost example. The first time I took a double inside breakout, right? And the reason why I love double inside breakout so much is because of a cost trade that I took last summer. So last summer, I took this cost trade where it had a double in, and this is like literally, I had like an epiphany. I was like, oh my gosh, like, so this just makes sense. So I saw this double inside 2 week, right? Double inside. So inside bar followed by another inside bar. And I was like, man, that's a double inside 2 week. So like, that's like a 4 week consolidation. And I was like, that would be cool if we consolidate for 4 weeks and then we break out for 4 weeks. Like, that would be cool. Then you know what we did? Consolidate for 4 weeks, 2 weeks, 4 weeks, 6 weeks, 8 weeks, 10 weeks. So the whole notion where I say that when you guys have heard me say, oh, the bigger the consolidation, the bigger the breakout, or how long you consolidate for is how long you break out for, that came from this trade that got us 800%. Because we had gotten, what was it, Costco 500s, and yeah, we got for Costco 500s, and we were $40 in the money. $40 in the money. Like, and that's why I tell people, bro, swinging is disrespectful. Like, y'all talking about you're gonna tell your friend, like, oh yeah, we just $10 in the money and I got 2 months left on a contract. It's disrespectful. And that's why I'm like, why doesn't everyone swing? Because you could, especially if you don't want to be sitting at looking at a chart all day. A lot of us have jobs and shit. So it's like if you don't want to be staring at a chart, buy time. Look at them higher time frame trades. Don't be staring at the daily. Don't pay attention to the 1530. You trying to get paid and get the bulk of the move when the chart is saying, hey, we have the potential to keep going up. I want that move. And that's been the type of trader that I've always been. That's why I love swing trade. So this double inside break told me, like, oh, so you consolidate for 4 weeks and you could potentially break out for at least 4 weeks. At least 4 weeks. Right? Now I have another example. And validation, Costco, that trade that I talked about on the swing trader's journey. If we look at the 2 week, why did I take Costco the last time when on that trade? Because we had a 1-3 on the 2 week. This is my entry. This was my entry when we called it out. Let me show you. Right? Entry right here. My invalidation, 50% of the previous bar. Did price ever get to your invalidation level? No. 2 up, 1-3, 2 up, 2 up, 2 up, 2 up. 500%. All I gotta do is buy time. Right? And like the beauty about swing trading is that it gives you opportunities to average down onto the play. Right? You have to understand that you're not gonna get paid initially. You didn't get the best entry because you trade the strat and you probably took the strat trigger. Unless you trade ICT and you're now taking the OTE entry, the discount entry. Okay, now you're getting the cheap entries, right? And that's why I say learn strat. I say market price action and market structure. If you learn price action and market structure, oh my gosh, you're going to go crazy. And sector rotation too. So you just know where institutions are placing their money, right? So that's your invalidation level for cost. Never broke. And then if you look at another trade, SO. I talk about SO. I talk about this consolidation, right? If we look at SO had, it was on the week, where was that triple inside last year? Okay, boom. SO last year, I was in this trade too, another 300% trade. And I'm not saying that to brag. I'm just saying that because I want to show you guys what's possible. That you guys can, if you guys came from like, oh, trim at 30%, trim at, I'm like, bruh, if you got a swing and you know where price is going, why not get everything? Why not get everything? Right? SO had a triple inside week. And what happened after this triple inside week? How many? We consolidated for 3 weeks. How many weeks did we break out for? 1, 2, 3, 4 weeks. So that's where the whole notion of however long you consolidate for, you can break out for. CCL, I already showed you that example on the 6 week chart, right? Double inside 6 week breakout, you're probably going to break out for 12 weeks. If you guys have been on my Twitter and you guys heard me talking about XLY 2 months ago, and I said, well, don't worry about it. Watch y'all. XLY, watch. You know why I said that? Because XLY on the 7 week time frame or on the 2 week time frame, double inside 6 week, telling us that you're going to break out for 12 weeks. If you consolidate for 12 weeks, think about this, y'all. This is just a 2, 1, 2 on a higher time frame. This is just a 1. Because this is inside this candle. Let's see if the 12 week actually shows it. Yeah, they don't show it. Trading View sucks with that. But this is just a double inside on a higher time frame. Right? And so if you're consolidating for 12 weeks, how long can you break out for? Does that make sense? So that's why when I see a double inside breakout, I pay attention. I'm like, oh, yep, because that adds to the magnitude of the play. When we talk about magnitude, how far a play can go, that's why we say, yo, you can look at a play right now and you can tell somebody where it's going to go a week, 2 weeks, a month, 2 months later from now. You can. We can tell you, hey, based off CL, based right now, we think CL going to 100. You know what I'm saying? So like, that's the beauty of the strat. And then what you have to do is use multi-time frame analysis as long as the higher time frame and the lower time frames are matching up. So you're saying that it's going to go 2 up on the 6 week. All right. So that means we got to go 2 up on the 3 week, 2 up on the 4 week, 2 up on the 4 week, using these match actionable signals on all these time frames to create that better picture or that better visualization. Okay. That's another example. Oh, the most recent trade that I'm in right now, COP. And the reason why I'm in, because COP on the 3 week gave us what? 4 inside 3 weeks. So you consolidated for 3, 6, 9, 12. And that is why. That's why I'm saying, like, bro, it ain't magic. At this point, it's just supposed to do what it need to do. And that's why we have the confidence as traders. So it's going to give you confidence as a trader. And people can call it arrogance, but it's like, nah, I'm listening to the chart. The chart said you consolidated for 12 weeks, created higher lows. And for those of you that know market structure, you're creating higher lows on a higher time frame as well. You're hammering. Look at these wicks. Pop. There you go. As expected. We didn't. No, we expected that. That's what was supposed to happen. You get what I'm saying? So you got to look at these higher time frames because look at every single time frame. Look at every single time frame. Every single one. Every single time, because it creates a better picture. All right. Another trade. This is just in validation level. We're currently up 600% on this trade. But the reason why, what's crazy about this trade is that we were down 50%. And I told people, I was like, yo, I'm down, but I took it based off the 2 months. So I'm not getting out. Like, so this is what happened. Let me show you real quick. Velo, right? I took it based off the 2 months. First of all, notice the demand zone that you can see right here with the creation of these wicks. So demand. They're not letting Velo break below 105. We got a hammer on the 2 month. Watch what happens. We trigger 117. I say get 130 calls for September, right? And I said this was on June 30th. So next, it triggered, right? We enter. Look what happens. It goes down. Those September cons are down 30% now. Then it goes down a little bit more. We're down 50% on the September cons. But I tell people my invalidation is 50% of the 2 month. Why did I take the trade? I took it based off the 2 month chart. So I know the play is going to take at least 2 months. Remember the reason why you got in the trade. If you took it based off the 2 month chart, you were already going into it anticipating it's going to take at least 2 months. So you shouldn't be getting out during week 1 or week 2, as long as it don't invalidate. Now, if it invalidates during week 1 and week 2, where it closes below 50% and it closes, well, actually, it's a 2 month candle. So really, you got to wait for the 2 month candle close, right? But if we got a 2 month candle close below 110, then I get out. But until then, no. It comes down 50%. We say buy more. Look what happens. Now you start to hammer, right? Now you're down 30%. Then look what Velo starts to do. He's going. Boom. Now we are in the money at 130, right? Not only that, Velo continues to go up and is out at 139. 600% last Friday. And all you had to do was just mark your invalidation level and understand the reason why you got into the trade. You got it based off the 2-2 rev on the 2 month. You set the target as 142 because that's what the strat said. Then you wait till price either hits your invalidation or go to target. Okay? All right. So these are just a couple of the chart examples that I have to show you the power of trading and swinging. Oh, actually, there's just one more. This is one more. So I look at BA. Where was it? Was it BA? Yeah, it was BA. 121. Yeah, BA. So like, I look at trades like this, right? Because people say like, oh, get out of trades. And I'm like, why? I say, if you look at beyond this 3 month, right? They bought BA. They started buying at 121 and BA got to a high at 196 on the quarter. So I asked myself, I said, if institutions or somebody was in that play for the entire quarter because they were a quarterly participant, why can't we get that move? Like you see it, y'all. We see these charts on a quarterly time frame. We see a candle like this from 120 to 194. We know price did that the entire quarter. Why couldn't somebody just sit on some 140 calls for December and then be $50 in the money? You could have. So it's these charts that, you know, that I like, that I'm like, you know what? This higher time frame is saying you have the opportunity to go crazy. Why not just sit in it? Because the higher time frames say so. Okay. Hopefully that makes sense. Thank you all for coming out. Thank you all for coming out to listen to me speak. Like I said in the beginning, I'm just a guy who just found out trading options about 3-4 years ago. And I said, this is one of the things that's going to help me, help my family, help all those around me. And then the fact that we have the resources where we're able to do this off of our phones, have these softwares where we can just look at charts. I tell people, like, we make money off of patterns. Like we make money off of patterns. Like, I don't think people realize like how powerful that is, that what these charts would literally give us the ability to change the lives of many. So that's why I really, really do. I want people to learn this. I want people to study it, get it. And if you have any questions, please feel to ask. If you're in it, I know Kevin doesn't do this, but like, if you're in a trading community, or if you know people that are not answering your question, trying to help you out, dude, to get out of that community. You're lucky you have Kevin, where he's teaching you and having people like just come up to teach these strategies, because he ultimately wants to see you succeed. So I appreciate you, Kevin, for having me. And like these tools that you guys learned, share it to your friends, share it to your cousin, share it to your family member, show them what the strat is. That's what Rob wanted. That's what he ultimately wanted. He wanted to teach this to as many people as possible. And it's up to us to continue this message. And that's what I like to say. And that's what we'll end it on that.